Hello, and welcome to another episode of the Commercial Real Estate Contrarian, where I attempt to properly show investors and brokers how to underwrite commercial real estate deals. If you haven't been to the intro video to kind of find out a little bit more about why I'm doing this, please go there first and view that. This video may make a little bit more sense after you view that, but this video is about NOI and cap rates and essentially why they are not meaningless, but just the term, hey, what was the cap rate on that deal, is essentially useless. And I'm going to go through several examples on stabilized versus unstabilized properties versus core properties and point out why that number, that percentage, that cap rate percentage is so irrelevant. So I'm going to go through a couple examples. Here is an example of an office deal that we underwrote recently. Our company underwrote recently. It's a 46,000 square foot building. This happens to be office. It's 27% vacant, 73% occupied. Okay, so here's a look at our rent roll. We've got 11 tenants. 2 of them are vacant. This entire fourth floor is vacant. So that's 25% of the entire rent roll. Pretty big, right? So on the tenants' start dates, we have those in this column, and then expiration dates in this column. We're going to come back to this in a minute and figure out why it's so important. So right now, our monthly rent, this is a rent roll, so this was, I believe, the end of, I think the middle of 2022 is when we underwrote this. So in this particular month, there was $51,000 coming in the front door. This is in terms of gross rent. So in-place gross rent. This number is in-place gross rent is the current monthly 51,590 times $12. In this particular case, there was no vacancy because it's already so vacant. And then the operating expenses. So I'm gonna get back to this in a minute, but the gross income, this is monthly annualized. Remember, monthly annualized, less the year one operating expense, gives us an in-place net operating income of $257,000. Now, the asking price on this is $6.1 million or $130 a square foot. So that gives us an asking cap rate of 4.2%. And you might say, geez, 4.2%, that sounds pretty low for, an office building in a suburban, setting. And you're absolutely right. It is low, but that doesn't tell the whole story. What I'm trying to show in this video is that this number, this NOI number, is so it's a very, very nebulous number, and there's multiple different ways to calculate it, and that means that the cap rate is almost nebulous as well. So what we did is we said, look, for every single one of these spaces, every single one of these tenants, what is the market leasing assumption? If there were a tenant, the space was for lease, and what would the market rate be? Maybe we ask $20 a square foot, but in this particular case, we think that it's going to settle out at $19 a square foot. I broke up this building into 2 market leasing assumptions. Spaces that are under 2,500 square feet and spaces that are over 2,500 square feet. And I thought that I could get a premium for the smaller spaces, a little bit lower number for the larger spaces. So in this particular case, these first 2 on the first floor, one's 5,800 square feet, the other's 4,800 square feet. So this MLA, market leasing assumption, is the over 2.5 thousand square feet. Those are $19 a square foot. And again, I think I can get about a quarter more for the smaller spaces. So this column then simply takes the rate, $19 times the square footage. This is the annual market gross rent that this particular space would carry. You carry that formula down, and if every space in the entire building was leased out at market rate, the total income would be $886,000. So stabilized gross income is $886,000. I think that this particular market is about a 12 and a half vacancy, sub-market. You can argue about that all day long, fine. So the vacancy, you take off $110,000 and you're left with $775,000 in, again, gross income. This is all of the income for the entire building. Subtract out your operating expenses, which again, I'm going to cover in a second, but you notice that the operating expenses are the same in this and this, and it leaves you with a stabilized NOI. Stabilized NOI, again, this is not current. This is if everything was at market, of $413,000. Now that's a far cry from the in-place $257,000, right? So there's several things that I need to look at when I'm factoring this in, okay? One, this market rate right here is $19, but the tenant is currently paying $20. So they're actually paying above market. Why that is, there's a multitude of reasons. We can cover that later or in a different video. This one, they're also paying over market. This one, they're paying over market, over market. So when I look at that, maybe I can push these up a little bit. Maybe I can say, okay, maybe I get $20 or $20.25, but then the building next door, they're only getting 18. So that's why I felt comfortable with this $19 and $19.25 a square foot. The other thing is the vacancy factor that you need to pay attention to, or at least consider. I'm not a huge fan of vacancy factors when you're using Argus Enterprise because it already takes into account the vacancy. So if you don't understand Argus Enterprise, don't worry about it. I'm sure I'll make 10 videos about Argus Enterprise, but just know that I'm just not a fan of it. It's almost like you're double dipping. You're taking out a vacancy in Argus, but you're also just including a random vacancy as well. So anyway, stabilized NOI here versus your in-place NOI. The other thing that you have to look at is the expiration schedule. If I look at the expiration dates here, this one expires at the end of the year, the first quarter of next year, first quarter of next year. It seems to me like there's a lot of rollover. So let's look at the rollover schedule. When I look at the rollover schedule for this property, it's in really bad shape. Notice that in year one, in 2022, there's 10,000 square feet that's expiring, or 33% of the building. In the following year, which again was the first quarter, if you remember from the rent roll, there's another 4,100 square feet, so another 13%. So all told, in basically the first year, year and a half, you've got half of your rent roll expiring. So when I go back to, we're talking about NOI here. This is in place. This is month one NOI. What happens in that year, in that first year, to some of these tenants that expire? Does their rent go away? Does it renew? Those are assumptions that every buyer has to make, and those are going to factor in to the NOI. So let me show you what I mean. We factored in, and I'm not going to get into all this, but we factored in about a 75% renewal probability. So when I go to my cash flow, this is an export from Argus. When I go to my year one NOI, I'm at $142,000. So I take all of here's my potential base income, but then actually when you factor in all of the absorption and turnover, that's a big number right there. I've only got $500,000 coming in the front door, and then I still have to pay my $340,000, $350,000 of operating expenses. So I'm only left with an NOI of $142,000. Now look, right now it's currently at $257,000, but because of all these rolls in the end of 22 and 23, it's going to decrease my NOI. And that's a far cry from the stabilized NOI. So I've got a range here of what I say, $140,000, $140,000 to $257,000 to a stabilized $413,000. So a cap rate is almost just irrelevant. If I buy this deal for whatever, $5 million, $6 million, whatever I buy it for, and somebody says, what was the cap rate on that? Pick a number. I mean, just real quick, the from the Argus, we said that the NOI was $145,000. If we take $145,000 divided by, the asking price of $6 million, that's a 2.37 cap rate. That that that's low. That sucks, right? So if I go back here to my stabilized NOI, this is what the building would be worth if it was stabilized and everything was just at market value. So what I do is I take, I think that this is about an 8%. If everything was stabilized, this is about an 8% cap rate. I think when we underwrote this, the 10-year Treasury was at like 4%. So this is 400 basis points over that. So that kind of feels right. So I think that stabilized value is NOI 413,000 divided by an 8% cap rate, or $5.1 million. I think that the stabilized value of this is about $111 a square foot. Notice the asking price here is $130 a square foot. And then I've got just a range. If I'm off a little bit and it's a 7.5 cap, versus an 8, it's worth $120 a foot. If I'm off on the low side and it's an 8.5 cap, then it's about $105 a square foot. So again, this is what I think it's worth stabilized. So fun fact, on this particular deal, we actually did not get it. We submitted an offer at, I want to say, like $90 a square foot, and it ended up selling for, I think, $95 or $96 a square foot. So a far cry from the asking price of 6.1, but still much higher than I would have wanted to pay for it. So this is just one example of different ways to calculate NOI and why cap rates are so kind of irrelevant. Here's a second example, example 2. In this particular one, we have 4 buildings. Here is there's a cafe and then a GSA tenant in building 1. There's several tenants in the second building with 1 vacancy. More GSA tenants in the 4th building. So total, there's 106,000 square feet between the 4 buildings. It is also 76% occupied. The guidance on this is $11 million, or $104 a square foot. So again, what I've done is the current monthly income. These are gross numbers. Current monthly is $103,000 times 12, $1.2 million in gross revenue, less the year 1 or estimated operating expenses of $650,000, gives me a current NOI of $600,000. And if I think that I want to pay an 8.5 cap, 8.5% on the 594 is $6.9 million, $7 million, or 66 bucks a foot. Okay, keep that in mind. We'll come back to that in a minute. What I've done here, that I didn't do in the other one, but it was pretty easy to do, is I said, let me look at some of these leases and see whether they're above or below market. What is the percentage that they are above or below market? And I said so you have to look at these 3 columns right here. I said that the cafe, they're basically give that space away. Charge them $2 a square foot, and then $2 combined with their operating expense reimbursement, charge them $8.50. That's more of an amenity, so I'm happy to kind of give that space away. GSA tenants, $18.50 a square foot. If you're a regular office user versus a GSA tenant, pay $18 a square foot. You can usually charge a little bit more for the government because of all the bullshit that you have to put up with. So here's all of our MLAs. And then here's the percentage above or below market that each of these tenants are at. So This particular tenant is paying $15 a square foot. They should be paying 18, so they're 16.7% below market. Okay. So this column, I say if everybody, similar to the other one, if everybody's paying at market, this particular space, 1850 times 12, 162,000, $18 times this square footage of 6,400 square feet is $115,000. So when you add all these up, if everything was at market, if all the spaces were rented at full market, it would bring in about $1.9 million. 10% vacancy rate in this particular submarket gives me a adjusted gross income of $1.7 million, less my operating expenses of $6.15 a square foot is about $1 million, $1,058,000 in stabilized NOI. Again, this is not current. This is what the building would produce if it was stabilized. And then the resulting price, again, this particular market, 8.5% cap rate, $117 a square foot. So the guidance is $104 a square foot, okay? And if it was stabilized, it would be about $117 a square foot. The other thing that I like to do, and this is kind of a gut check, is, and I won't spend a lot of time on this, but I say stabilized value today, that's this number, this 12.45, $117 a foot. What if I just grow this at inflation? 10 years from now, how much is this going to be worth if it just kind of just generally appreciates? What I'm doing here is I want a double check or a gut check when I look at my terminal value in year 10. If after all of my analysis is done, I have a terminal value of like $24 million or something like that, I know that that's probably just too much. It's just too much of an increase in appreciation. So just something that I like to do to kind of double or triple check. In this particular case, this is a marketed deal, and so the broker gave their own market leasing assumptions. And so here's what the broker says. The broker says that the gross potential income is $1.8 million, less their vacancy is $1.6 million, less operating expenses. So their stabilized NOI is $993,000. That's actually not too far off from mine. Now, one thing that you might notice is that the broker says that this particular space, these office spaces, should rent at $16.50 a square foot. But I've got $18 a square foot. Typically, brokers are so aggressive. But what I'm doing is what you don't see in this particular analysis is the amount of money, the amount of capital that I am spending to reposition this building. I'm saying that I'm going to spend another, I don't know what the number is, it's on the financial analysis tab, but I'm going to spend another, $5 million above my purchase price to reposition this building. And so after I do that, I'm going to be able to get $18 a square foot for the office tenants and $18.50 for, the GSA tenants. So again, just because a broker has their numbers, they also likely don't have any capital. Like, oh yeah, the roof's fine. You don't need to replace the roof. Oh yeah, the HVAC units, sure, you replace them whenever they break. Landscaping is just fine. No, I want to go in and reposition this asset, all four of these buildings, so that I can achieve the highest rents in the market. So again, just another example of different ways to look at NOI. And in the last example, I've got here for this is a single story office building that we were looking at. This was 70% occupied. Here's all your tenants. The rollover schedule on this is actually pretty good. There's not a lot of rollover in the first few years, so that's actually a good thing. In this particular case, these are triple net leases, and then here's kind of my same thing. These tenants, I broke it up into sub 5,000 square feet spaces, over 5 to 10,000 square foot spaces right here, and then also over 10,000. So I have three different market leasing assumptions. It looks like $10 a square foot, $10.50, and $11. So annually, stabilized potential base rent. This is just the base rent, and then you're also collecting CAM on top of that. So your potential gross income is, a little over $1 million, less your vacancy. In this particular case, this market's a little bit worse, so it's 15%. And then your stabilized NOI is $924,000, less the operating expenses, which are exactly the same as the recoveries. So your stabilized NOI is $650,000. Um, and then again, 8.5% cap rate if it was stabilized. So again, this is a far cry. This $650,000 is a far cry from the current in place NOI. And that's what I'm kind of trying to get you guys to understand is the NOI is so variable. It changes from investor to investor month over month. What if I felt that I had the best leasing team in the area, and I was able to lease these up in the first 6 months after I bought it? You would have additional NOI. You'd have additional income in that first year that isn't accounted for on your in place. Yet it's not going to be, you know, all the way up to your stabilized value here, your stabilized NOI. But it's just there's so many factors that go into it, not to mention the rollover, and we haven't even talked really about the operating expenses. The operating expenses can be adjusted so much from buyer to buyer that the NOI is so random. And so if you ask the seller, the buyer, the seller's broker, and the buyer's broker all the same question, hey, what was the cap rate that traded at? You'll get 4 different answers that could be 400 basis points off. So these are just a few examples of NOI and cap rates and why they're essentially useless. All right, I wanted to just throw out another example. This is what's going on in industrial right now. Industrial is so hot. Market rent has been so crazy that cap rates are essentially irrelevant in industrial real estate right now. I feel like, especially for maybe for like the longer single tenant net lease deals, it's perfectly fine to kind of quote cap rates and look at cap rates. But if it's a multi-tenant or a value add deal, cap rates are completely irrelevant. Let me show you why. Let's say that the in-place rent is $10 a square foot net, and that market rate is $10 a square foot net. If you have a long-term lease in place and those in-lease escalations are escalating at 2.5%, that's what this line is. It's $10 growing at 2.5% per year. But let's say that the market is growing at 6% a year, and then down to 5% and 4% and 3%. If you think that these are high numbers, these are actually low. In some markets across the country, your gateway markets, LA, New Jersey, Dallas, South Florida, rental rates are they have been, I think that they've stabilized, but they were growing at like 10% a year for like 3 or 4 years. It was crazy. But I would say on average, across the country, it was like 6%, 6%, 5, 5, 4. Now it's kind of stabilized. So that's what this number is market rent grown at the inflation rate that the market is growing at. So you can see that if you have a long-term, triple net lease growing at 2.5%, by the end of 10 years, you're already 17% below market, and that's if you started at the same base number. So if you just apply a cap rate to that of 5% across the board, today the value is $200 a square foot, but by the end of the 10 years, you're $50 a square foot differential between your building that's at a market rate versus where you could be if the building was rented at market. So what if though, and here's why I say that cap rates are almost irrelevant in industrial. Say that you've got an in-place rent of call it $7 a square foot, but market is $10 a square foot. And so when you're buying a building and the current tenant is paying 7, you're already 30% below market. They're paying 30% below market. And if their lease expires in year 1 or year 2 or year 3, you as an investor might be willing to pay a very, very, very low cap rate because you know that in year 3, especially if they don't have any options to renew, that you can go from 735 to 1124. You can increase the NOI by 34% pretty easily, and then so your in place cap rate may be extremely low that you're willing to pay because you know that in 3 years you'll be at $225 a square foot. So you really just have to understand the ability that you have as an investor to increase rents. If this is a long-term net lease and you don't have the ability to access the rent roll or get to the rent roll, then why are you paying a 4 cap, on this deal when your borrowing rates are at whatever 375, and the weighted average cost of debt for the tenant that's in place is like 4.25. You're better off lending the tenant debt versus owning the real estate and only collecting 4%. So be very, very mindful of where rents are in relation to market, how that translates to NOI, how you're able to access the rent roll, how you're able to get to the ability to change the NOI, and that way your cap rate may be, you may be paying a 2% cap rate on something and feel just fine, knowing that you can get to a stabilized 5% cap rate very, very quickly. So in any event, this is my take on cap rates. If you disagree, please let me know. If you want to follow my channel, please do. If you don't, that's fine too. I really don't care. As I always say in all of my videos, I'm not trying to sell you anything. I'm not trying to sell you spreadsheets or a course or anything like that. I'm just trying to make y'all better at what you do, because some of the stuff that I see in my industry is just downright pitiful. So if everybody can work to a higher level, I think our industry as a whole would be better off. Thank you. Talk soon.